Welcome viewers to this video on understanding share market investments. This is your comprehensive guide, an in-depth exploration in the world of investments, specifically focusing on the share market. An investment journey that will help you unravel the mysteries and complexities of the share market. The share market many times can prove overwhelming for both beginners and seasoned investors. The myriad of terms, principles, different types of investments, and the ever-changing market trends can leave one feeling disoriented. This video session aims to simplify these complexities, navigate through the labyrinth of financial jargon, and empower you with knowledge, making you a confident investor. We will begin with the fundamentals, tracing back to the origins of the share market and decoding its relevance in today's economic scenario. The share market isn't just a complex web of buying and selling shares, it's a pulse point of an economy, a barometer of a nation's financial health. We will dive deep into the basic principles of the share market and its impact on global economies. Next, we will explore the different types of investments available in the share market. From equities to bonds, ETFs to mutual funds, futures to options, we will deconstruct each one of them. This will not just help you understand the versatility of investments available, but also aid in making informed decisions about where and how to invest. Our discussion will then transition to brokers and their charges. We will not only demystify the role of a broker in the share market, but also provide a practical guide to broker charges, commissions, and other fees. We will help you understand how to select a trustworthy and affordable broker, ensuring a smooth investment journey. After this, we will delve into understanding profits and losses. We will examine the different factors influencing profits and losses, illustrate with real-world examples, and provide tips and strategies to maximize profits while mitigating. We will learn about scams and risks associated with the share market. We will detail different types of scams, red flags to watch out for, and protective measures to avoid falling prey to such scams. We will also discuss risks, both market-centric and individual, and how to manage them effectively. We will then explore income tax implications associated with share market investments. We will elucidate on how profits from investments are taxed, tax-saving investment options, and important tax laws and regulations you need to be aware of. Subsequently, we will weigh the advantages and disadvantages of investing in the share market. Investing in the share market is not without its perils, but it also offers promising returns. We aim to present a balanced view, helping you make an informed choice. Towards the end, we will delve into the primary and secondary markets, their differences, relevance, and impact on your investment decisions. We will finally touch upon significant stock exchanges such as the NYSE and NASDAQ. We will delve into their history, functionality, and importance in global trading and investment. So as we embark on this journey together, we hope to make the subject of share market investments less daunting and more approachable for you. Let's begin with the basics. The share market is a platform where stocks and shares are bought and sold. It plays a crucial role in the economy by facilitating the flow of capital. We will also differentiate between primary and secondary markets and touch upon stock exchanges such as NYSE and NASDAQ. Moving on, we are about to venture into the vast realm of investment types. Our journey will take us through the variety of options available to people who wish to grow their wealth and secure their financial future. We shall start with the cornerstone of any investment portfolio, cash. Cash, though not the most exciting of investment types, is an essential component that cannot be overlooked. It acts as the base upon which all other investment decisions are made, and its importance cannot be understated. The key to liquidity, the ability to quickly convert your investments into spending money. We'll delve deeper into the role of cash in your portfolio, understanding its function as both a safety net and a tool for opportunity. We will explore how cash investments like savings accounts, money market funds, and certificates of deposit work, and their relative advantages and disadvantages. From there, we turn our attention to equity investments. Equity investments, or buying shares in publicly traded companies, offer potential returns, but come with their fair share of risks. These risks and rewards vary greatly depending on the specific investment. Crucial to understand them before diving in. We will define equity investments in detail, considering the nuances of investing in individual stocks, mutual funds, and exchange-traded funds. We will dissect the concepts of dividend income, capital gains, and the impact of market volatility on equity investments. After we've covered the fundamentals of cash and equity investments, we will shift our focus to a new digital frontier, cryptocurrencies. We will not only introduce you to cryptocurrencies but also delve into the intricacies of this digital currency landscape. We will discuss how to invest in cryptocurrencies, the risks involved, and how these digital currencies can potentially fit into a diversified investment portfolio. In addition to cryptocurrencies, we will also discuss investing in commodities. Commodities include tangible assets like gold and oil, and investing in them can provide a hedge against inflation and a method of diversification. We will take a deep dive into the commodities market, explaining how futures contracts work, the role of supply and demand in commodity pricing, and the benefits and risks of including commodities in your investment portfolio. Lastly, we will explain the world of options trading. Trading is a more advanced type of investment that deals with the buying and selling of options contracts. These contracts give the holder the right, but not the obligation, to buy or sell an underlying asset at a specified price within a certain period. We will detail the risks and rewards of options trading, providing examples to help you understand the mechanics of different strategies. We will also touch upon the psychological aspects of trading, importance of diversification, risk management, and the effects of global economic events on investment strategies. It's a comprehensive exploration designed to give you a well-rounded understanding of the investment world. So buckle up and prepare for an in-depth journey into the world of investing. We will also introduce cryptocurrencies and digital currencies, discuss investing in commodities like gold and oil, and explain options trading and its risks and rewards. Next, we will dive into brokers and charges. To put it succinctly, a stockbroker is an entity, a person or a firm, that acts as an intermediary between buyers and sellers of stocks. They facilitate the transaction process, making it smoother and more manageable for both parties involved. Now, we'll delve into this topic a bit more, providing you with an in-depth understanding of stockbrokers and their vital role in the world of investment. Starting with their definition, stockbrokers are licensed professionals who buy and sell securities on behalf of their clients. They are also known as securities sales agents or registered representatives. When we talk about securities, it covers such as stocks, bonds, mutual funds, and other investment products. A stockbroker, therefore, is an essential part of the investment sector, bridging the gap between an investor and the financial market. The primary role of a stockbroker is to execute buy and sell orders for securities on behalf of their clients. They make trades on various securities exchanges and other platforms. It's their research, advice, and expertise that saves you time and energy, allowing you to make informed decisions about your investments. Having briefly gone through what a stockbroker is, let's delve deeper into their responsibilities. A stockbroker is not just a facilitator of transactions. Their duties extend to providing financial advice, researching and analyzing market trends, developing investment strategies, and managing portfolios on behalf of clients. They offer these services in exchange for a commission or fee, known as brokerage fees. At this juncture, it's essential to understand that stockbrokers come in different types. These include full-service brokers, online brokers, and discount brokers, each having its own set of fees, services, and mode of operation. Full-service brokers provide a broad range of services, including financial planning and advice, tax tips, research, and more. They charge the highest fees among the three types. On the other hand, online brokers online platforms. They provide tools for you to manage your investments, but they don't offer advice. Their fees are often lower than full-service brokers. Discount brokers, as the name suggests, offer discounted brokerage fees. They provide fewer services compared to full-service brokers, but they're a good choice for self-directed investors who don't need extra services. But how do these fees work? Brokerage fees are the cost you pay for the service of executing trades or managing your investments. These fees can take several forms, including commissions, spreads, management fees, and others. They are crucial to consider as they impact the overall profit or loss on your investments. As an investor, it's natural to focus on potential profits. However, it's also important to note that brokerage fees can eat into these profits. This is why we emphasize understanding these charges, comparing different brokers, and making a choice that aligns with your investment goals and strategy. When choosing a broker, it's not just about the fees, it's about finding a trusted and reliable partner who will assist you in navigating the complex world of investing. It's about finding a broker who understands your financial goals and can help you achieve them in the best possible way. Lastly, while fees are essential, the broker's knowledge, expertise, and service quality are equally important. You want to work with someone who has a solid understanding of the market, can provide you with useful advice, and can help you make the most of your investments. In conclusion, selecting the right broker goes beyond just fees. It encompasses a broad range of factors that, when carefully considered, can significantly influence your investment outcomes. We will also discuss brokerage fees and emphasize the importance of choosing the right broker for your investment needs. Understanding profits and losses is crucial in the share market. This concept is no small feat to truly grasp, as there are many variables, factors, and elements that play into the calculation and understanding of profits and losses. Now, let's go a little deeper into this. Profits and losses are essentially the measurable outcomes of your investment activities. A profit is when your investments yield a financial gain, whereas a loss occurs when they result in a decrease in funds. Understanding this is not just about knowing the difference between a profit and a loss, it's about developing a keen sense of judgment and foresight into the market trends. It's about understanding the market's ebbs and flows, highs and lows. Now, how are profits and losses calculated? This might seem like a complex question, but once we break it down, it's quite straightforward. The calculation is based on your purchase price and your selling price. If the selling price is higher than the purchase price, you've made a profit. If it's lower, you've made a loss. But remember, there are costs involved as well, such as taxes and transaction costs, which can eat into your profits or add to your losses. Let's delve further into the concept of capital gains and losses. A capital gain occurs when you sell an investment for more than you paid for it. A capital loss, on the other hand, is when you sell it for less. Capital gains and losses are not realized until the investment is sold. Until then, any potential gain or loss is just that, potential. This is an essential concept to grasp, especially when you are planning your tax strategies. Your capital gains and losses can significantly impact your tax bill, and understanding how they are calculated can help you effectively plan your investments and manage your taxes. To provide clarity, let's look at some examples. Let's say you bought 100 shares of Company A at $10 each, which means your total investment is $1,000. If you sell those shares for $15 each, you've made a capital gain, as your selling price, $1,500, is higher than your purchase price, $1,000. However, if you sell those shares for $7 each, your selling price, $700, is lower than your purchase price, $1,000, and you've incurred a capital loss. Now, the question arises, how do these gains and losses impact your investments? Before we dive into this, it's important to remember that investing is not just about making profits. It's about learning, understanding, and growing. It's about making informed decisions and managing risks. Yes, the ultimate aim is to make a profit, but even losses hold valuable lessons. Investments are subject to market risks. Market trends are unpredictable, and sometimes, despite all your analysis and predictions, you might face losses. However, understanding profits and losses can help you navigate through these market uncertainties. It can help you make informed decisions about when to hold on to an investment and when to let it go. It can also guide you in diversifying your portfolio, which can potentially help you balance out any losses with gains from other investments. In conclusion, profits and losses, capital gains and losses are not just concepts to know. They are tools that can help you navigate the turbulent waters of the share market. With proper understanding and strategic application, these tools can help you maximize your gains, minimize your losses, and ultimately, enhance your investment portfolio. Through examples, we will illustrate how gains and losses can impact your investments. Scams and risks are prevalent in the investment world, and we will shed light on common investment scams such as Ponzi schemes and pump and dump. The world of finance is swarming with opportunities and pitfalls alike, and it is essential to understand the landscape to steer clear of financial disasters. When it comes to investing, it's not just about making money but also about protecting it from the scourge of scams. Investment scams are as old as the markets themselves. The term scam is often associated with duplicitous attempts to swindle innocent investors out of their hard-earned money. Understanding how these scams operate can be your first line of defense in avoiding them. In the vast ocean of investment scams, two of the most notorious types are Ponzi schemes and pump and dump scams. Invented by Charles Ponzi in the early 20th century, Ponzi schemes lure investors with the promise of high returns. The money from new investors is used to pay profits to earlier investors, creating a false sense of security and prosperity. But this house of cards inevitably collapses, leaving those who invested last with nothing but losses. Pump and dump scams, on the other hand, operate by artificially inflating the price of a low-value stock, the pump, and then selling it off at its peak, the dump. The unsuspecting investors left holding the worthless stock find themselves at a loss, while the scammer walks away with a tidy profit. In the complexity of financial markets, these scams can appear incredibly convincing and sophisticated. The fraudsters often use high-pressure sales tactics, promising quick returns and exploiting the fear of missing out. They make the investment opportunity sound exclusive and time-limited, forcing investors to make hurried, uninformed decisions. To combat this, we must emphasize the importance of due diligence. This term refers to the comprehensive analysis an investor must undertake before making any financial commitment. Due diligence goes beyond just reading the company's financial statements. It's about understanding the company's business model, its competitive landscape, and the overall industry trends. It involves checking the credibility of the company and its directors, and cross-verifying any claims made by them. Even with due diligence, sometimes it's challenging to identify scams on your own. That's why we'll provide some practical tips to help you avoid becoming a victim. Firstly, if it sounds too good to be true, it probably is. An investment opportunity promising high returns with little risk is a telltale sign of a potential scam. Secondly, never invest based on a hot tip or pressure from someone else. Always make financial decisions based on thorough research and your personal financial goals. Thirdly, be wary of unsolicited investment offers, especially those that come through email or social media. Lastly, seek advice from financial advisors who have a proven track record and are registered with regulatory bodies. In conclusion, always remember that in the world of investing, there are no shortcuts or easy ways to make money. It requires patience, understanding, and a significant degree of due diligence. So arm yourself with knowledge, be cautious, and always remember, haste makes waste. We will stress the importance of due diligence and provide tips to identify and avoid scams. Understanding the implications of income tax is crucial when it comes to investing. Income tax is one of the most critical aspects of personal finance, and an in-depth knowledge of this subject is invaluable. For those who venture into the realm of investing, the understanding of how income tax works can immensely change the game. It can be the deciding factor between a profitable investment and a financial pitfall. For this reason, we have compiled an exhaustive video to cater to your needs by providing a comprehensive guide on this topic. This video will set off with an in-depth discussion regarding the influence of taxation on the income generated from your investments. The world of taxes can be incredibly complex, full of nuances and intricacies that need to be thoroughly understood. However, with a solid grasp of these concepts, you can make informed decisions about your investment strategy and potentially save a significant amount of money in the long run. The video will dive deep into the details of how your investment income is taxed, examining the various tax brackets and explaining how these brackets could impact the decisions you make regarding your investments. The primary aim of this section is to provide you with clear, understandable information about how taxation can affect your investment returns if not managed properly. For example, did you know that the type of investment income you earn can also influence how much tax you pay? This is just a glimpse of the kind of information you will find in our video, which is packed with insights to help you navigate the complex landscape of taxation. Following our exploration of investment income and tax brackets, we will delve into a comprehensive explanation of capital gains tax. Capital gains tax is often a complicated subject, with fluctuating rates that can significantly impact your returns. It is a tax that you will have to pay on the profit you make from selling an investment, and it can sometimes be quite substantial. In the video, we will break down the concept of short-term and long-term capital gains, discussing the detailed tax rates for each and explaining how they apply to your investments. We will also delve into methods to calculate capital gains, tax, and strategies to minimize the same. We aim to simplify the concept of capital gains tax and make it easier for you to understand how it affects your investment returns. As we continue to delve deeper, we will shed light on tax deductions and exemptions related to investment income. This will include an intensive discussion on the tax benefits associated with different types of investments, and the rules and guidelines for claiming these benefits. Understanding the intricacies of these deductions and exemptions can ultimately help you make more strategic decisions about your investments and potentially save a significant amount of money. One crucial aspect we will discuss in our video is the myriad of tax-saving investment options available to you. We will provide an in-depth exploration of the different types of tax-advantaged accounts, such as 401(k)s and individual retirement accounts, IRAs. These accounts can offer you unique tax benefits, and understanding how to leverage them can be a valuable tool in your investment arsenal. For each type of account, we will delve into its unique benefits, discuss the contribution limits and withdrawal rules, and explain the tax implications associated with them. We will offer practical tips on how to utilize these accounts for maximum tax savings. This information is critical if you hope to make the most of your investments while minimizing the amount of tax you owe. To ensure you stay engaged and absorb the information easily, our video will feature interactive on-screen visuals. These graphics and animations will underscore key points, illustrate concepts in an easily digestible manner, and help you visualize the impact of taxes on your investments. We believe that the combination of engaging visuals and a clear narrative will make the complex topic of tax simple and understandable for everyone. A key portion of the video will also involve a section dedicated to frequently asked questions, FAQs. This segment will address common queries and misconceptions about income tax and investments. You will find answers to questions such as, what is the difference between tax avoidance and tax evasion? And, is it possible to invest and not pay taxes? Amongst others. To sum up our video, we will provide a succinct summary of the key points discussed. We believe that recapping the main points will reinforce your understanding of the concepts presented. We will wrap up the session with a quick quiz designed to test your understanding of everything covered in the video. This way, you can gauge your grasp on the subject matter and identify areas that need further study. This feature-length 1-hour video aims to provide all the information you need on the subject, allowing you to make better financial decisions. It is not just an information dump, but a thorough tutorial designed to give you the necessary expertise with regards to taxation. With the knowledge from this video, you can be one step ahead in your financial journey and make more informed decisions about your investments. We will then weigh the advantages and disadvantages of investing in the share market. As we delve into this complex financial world, it is crucial to understand that the stock market is not just about buying and selling shares. It is a vast universe that requires knowledge, strategy, and careful planning. Investing in the stock market can be a lucrative venture, but it's not without its pitfalls. The prospect of significant gains is indeed enticing, but it's crucial to remember that the market can also be volatile and unpredictable. Depending on the timing, you could either make a fortune or lose your entire investment. This is where the concept of risk factor comes into play. The potential for loss is part and parcel of investing in the share market. It's the formidable shadow that looms over every transaction, every decision to buy or sell. The higher the risk, the higher the potential return. But conversely, the higher the risk, the more substantial the potential loss. Risk isn't just about losing money though, it also refers to the opportunity cost, the potential returns that you forego when you put your money into one investment instead of another. Every investment decision you make comes with an opportunity cost, and it's crucial to consider this when making your investment decisions. To mitigate these risks, many investors resort to diversification, spreading their investments across a wide range of assets. Diversification isn't just about investing in different companies, it's about investing in different industries, different countries, and even different types of assets. Let's delve deeper into the concept of diversification. It's a strategy that aims to maximize returns by investing in different areas that would each react differently to the same event. Most investment professionals agree that although it does not guarantee against loss, diversification is the most crucial component of reaching long-range financial goals while minimizing risk. While diversification can help reduce the risks associated with investing in the stock market, it is not a foolproof strategy. Even a well-diversified portfolio can suffer losses. It is crucial, therefore, to monitor your investments regularly and adjust your portfolio as necessary. Besides, there's a psychological aspect to investing in the share market. It's not just about numbers and charts. Emotions can drive the market in unpredictable ways, and it's essential to keep a cool head and not let fear or greed dictate your investment decisions. Investing in the share market also requires patience. It's not a get-rich-quick scheme. Over time, however, investing in the stock market has proven to be one of the most effective ways to build wealth. It requires discipline, patience, and a good deal of research, but the potential rewards can be significant. In conclusion, Investing in the share market offers significant financial opportunities, but it also comes with substantial risks. It is not for the faint-hearted or those seeking quick profits, but for those willing to invest time and effort in understanding the market and developing a well-diversified portfolio. It can offer substantial rewards. We will emphasize the importance of maintaining a diversified portfolio to mitigate these risks. In conclusion, we've traversed the foundational terrain of the share market, an arena that is as vast as it is exciting, as challenging as it is rewarding. We've delved into the countless facets that make up this intricate world, as we embarked on a comprehensive journey of understanding and learning. Our first major stop on this educational journey was understanding different types of investments. We took the time to dissect the various finance vehicles, stocks, bonds, mutual funds, and the like, that form the backbone of the share market. Each investment type, with its unique features and complexities, was brought under the spotlight to give you a comprehensive view of their workings. From the high-reward nature of equity investments to the safer, smaller returns of bonds, we discussed it all. We then broached the vital subject of brokers and charges. We looked at the broad spectrum of brokers available, from full-service brokers who provide a range of services beyond just buying and selling stocks, brokers who offer no-frills, low-cost trading. We've dissected how they earn their commissions and how you can make informed decisions about picking your broker. Our conversation moved further into the mathematics of the share market. We took a deep dive into understanding profits and losses. We walked you through the calculation, interpretation, and implications of these figures. Additionally, we explored how they affect your overall portfolio and your financial health. Among the important subjects we covered were scams and risks involved. We touched upon the importance, vigilant and informed, showcased real-life examples of financial scams, and gave you tips to steer clear of them. We emphasized the significance of staying updated with market regulations and news. Another integral part of our discussion was income tax implications. We provided an overview of tax laws related to investment gains, how to report them, and how they affect your bottom line. We unraveled the mysteries of tax brackets, capital gains tax, and tax loss harvesting. We also evaluated the pros and cons of investing in the share market. We weighed the potential monetary gains against the inherent risks, the opportunity for growth against the possibility of loss. We emphasized the importance of diversification, risk tolerance, and long-term financial goals. The objective of this discussion was not only to impart knowledge but also to encourage you to continue learning. Investing is a lifetime journey, and we hope this video serves as a strong starting point. We underscored the importance of seeking professional advice when making investment decisions. We reiterated the importance of working with trusted financial advisors who can guide you based on your specific needs and goals. We want to emphasize that we value your opinion and hope this video sparked questions or comments about investing. We invite you to share them with us. For further assistance, we have provided valuable resources and our contact information in the description below. We urge you to engage with us and the community. Like this video if you found it helpful. Subscribe to our channel if you want to stay updated with more informative videos like this one. Share this video with your friends and family who might find this information useful. Thank you once again for your time and attention. Your desire to learn and understand the complexities of the share market is commendable. Remember, knowledge is power, and you are on your way to becoming a more informed investor.